The story of digital money begins not with computers, but with a simple, powerful idea. For centuries, humanity relied on physical objects to represent value: shells, salt, gold coins, paper bills. Each step was an innovation. Each step made trade easier. Yet, each system had its limits. Physical cash is, well, cumbersome. It can be lost or stolen. It is expensive to print, expensive to secure, expensive to transport. Most importantly, it requires intermediaries for almost any transaction that isn't face-to-face. Banks, credit card companies, governments. They are the gatekeepers of our financial world, a position that grants them immense power and control. This reliance on central authorities created friction. Every time we swipe a card or send a wire transfer, a complex and often invisible process unfolds. These intermediaries take a cut. They set the rules. They can freeze accounts and deny transactions. This system worked, but many began to wonder if there was a better way. What if we could transact directly with one another? What if we could have a form of money that was native to the internet? Secure, global, belonged to everyone and no one. This was the dream. It was a vision for a new kind of financial freedom, one built on technology rather than institutional trust. The desire for a purely digital form of cash wasn't just about convenience, it was a philosophical quest. In the late 20th century, the internet began connecting the globe. A group of thinkers known as cypherpunks saw an opportunity. They believed that cryptography, the science of secure communication, could be the key, protecting individual privacy, protecting individual liberty in a digital age. One of the earliest was David Chaum, a visionary computer scientist. He developed a concept called digicash in 1989. Chaum's system used cryptographic principles to create anonymous digital money. It allowed for secure, private online payments. Digicash was even piloted by a few banks. For a moment, it seemed like the future had arrived. However, the world was not quite ready. The internet was still in its infancy. E-commerce remained a niche curiosity. Digicash was ahead of its time and ultimately failed to gain widespread adoption. The company filed for bankruptcy in 1998. In the autumn of 2008, as the global financial system teetered on the brink of collapse, a mysterious figure appeared on the internet. Using the pseudonym Satoshi Nakamoto, this person or group published a 9-page white paper. Its title was simple and direct: Bitcoin, a peer-to-peer electronic cash system. The paper was a masterwork of synthesis. It elegantly combined the ideas of the past: anonymous transactions, proof of work, decentralized ledgers, into a single coherent protocol. Nakamoto had solved the double spending problem without needing a central authority. This was the breakthrough the world had been waiting for. Nakamoto's solution was a technology called the blockchain. Imagine a shared public record book. Every 10 minutes a new page or block is added to this book. Each block contains a list of recent transactions. To add a new block, participants known as miners must compete to solve a complex mathematical puzzle. The first one to solve it gets to add the block to the chain and is rewarded with newly created bitcoins. This process achieves two things. First, it makes it incredibly difficult and expensive to alter past transactions, securing the network. Second, it provides a controlled and predictable way to introduce new currency into the system. On January 3, 2009, the Bitcoin network officially came to life. Satoshi Nakamoto mined the very first block, known as the Genesis block. Embedded within its code was a message, a headline from that day's edition of the Times of London: Chancellor on brink of second bailout for banks. The message was a quiet but powerful statement. Bitcoin was born from the ashes of a failing financial system. It was presented as an alternative, a new path forward. It was a system built on mathematical proof instead of the fallible trust we place in institutions. Bitcoin proved that decentralized digital currency was possible. It was the single-celled organism that sparked a new evolutionary path. Soon after its success became apparent, a Cambrian explosion of new digital currencies began. Developers around the world started to experiment with Bitcoin's open-source code. They tweaked its parameters. They changed its features. They launched their own versions. These new cryptocurrencies came to be known as altcoins, short for alternative coins. One of the earliest and most notable altcoins was Litecoin. Launched in 2011 by a former Google engineer named Charlie Lee, Litecoin was positioned as the silver to Bitcoin's gold. It was designed to be faster and more abundant. While a new Bitcoin block is created roughly every 10 minutes, a Litecoin block is generated every 2.5 minutes. This meant transaction confirmations were quicker. Litecoin demonstrated that the core innovation of blockchain could be adapted and modified, opening the floodgates for thousands of other projects to follow. The next major evolutionary leap came in 2015 with the launch of Ethereum. Ethereum was more than just a digital currency. Its creator, a young programmer named Vitalik Buterin, envisioned it as a global, decentralized computer. Ethereum introduced a powerful new concept: smart contracts. These are self-executing contracts with the terms of the agreement directly written into code. They operate on the Ethereum blockchain, automatically carrying out their functions when specific conditions are met, without the need for any intermediary. To truly grasp the significance of digital money, we must look beyond the coins themselves. We must understand the underlying technology that makes it all possible: the blockchain. At its heart, a blockchain is a new kind of database. It is a very special kind, a distributed ledger. Not stored in one central location like a bank's server. The ledger is copied and spread across a vast network of computers. Everyone on the network has a copy. Decentralization, the first pillar. The second pillar is immutability. Once a transaction is recorded, it's permanent. It cannot be easily altered or deleted. This is because the blocks are linked using cryptography. Each new block contains a cryptographic fingerprint, a hash, that points to the block before it, creating an unbreakable chain. The third pillar is transparency. While identities can be anonymous, the transactions themselves are typically public. This creates what we call trust by computation. For many years, digital currency was a fascinating but abstract concept for most people. It was something traded by tech enthusiasts on obscure online exchanges. Today, that picture is changing rapidly. Digital money is moving from the fringes to the mainstream, becoming an integrated part of the global economy. One of the most straightforward uses is for payments. Remittances are another major use case. Sending money across borders using traditional banking can be slow, expensive, and honestly, pretty bureaucratic. Cryptocurrencies allow for near instantaneous transfers to anyone, anywhere in the world with an internet connection, often for a fraction of the cost. Beyond simple payments, digital currencies have become a new asset class. People around the world are now using them as a store of value, similar to digital gold. In countries with unstable economies and high inflation, cryptocurrencies can offer a lifeline. They provide a way for citizens to protect their savings from being devalued by government monetary policy. The rise of decentralized finance, or DeFi, has unlocked even more sophisticated uses. Built on smart contract platforms like Ethereum, DeFi applications are recreating the entire financial system in an open, permissionless way. Users can now lend their digital assets and earn interest. They can borrow funds by using their existing crypto as collateral. They can trade complex financial instruments on decentralized exchanges without needing a broker. All of this happens peer-to-peer, governed by code rather than by corporate intermediaries, making financial services more accessible and transparent for everyone. Furthermore, the technology is enabling new forms of ownership and creativity. Non-fungible tokens, or NFTs, are a prime example. These are unique digital assets on a blockchain that can represent ownership of anything from a piece of digital art to a concert ticket or a virtual piece of land. The ripple effects of digital money and its underlying blockchain technology are now spreading across the entire global economy. We are witnessing the dawn of a new economic architecture that promises to remake industries from the ground up. The core innovation, a shared immutable ledger for recording value and for transferring value, is a general-purpose technology. Much like the internet, its applications are vast and transformative. We are moving from an internet of information to an internet of value, where assets of all kinds can be managed and exchanged securely and peer-to-peer. Consider global supply chains. These are incredibly complex networks involving thousands of suppliers, manufacturers, and logistics partners. Tracking goods from source to consumer is a monumental challenge, often relying on fragmented paper-based systems. This leads to inefficiency, fraud, and lack of transparency. By using a blockchain, every participant can record their part of the journey on a shared, tamper-proof ledger. A consumer could scan a QR code on a bag of coffee and instantly see where the beans were grown, when they were harvested, and how they were transported. This brings unprecedented trust and accountability to commerce. The very nature of the firm is also being challenged. For over a century, the hierarchical corporation has been the primary engine of economic activity. But blockchain enables new models of organization. Decentralized autonomous organizations, or DAOs, are a glimpse into this future. A DAO is like an internet-native company, owned and managed by its members. Its rules are encoded in smart contracts on the blockchain. Decisions are made through voting mechanisms where members use tokens to signal their preference. This allows for large-scale coordination and value creation without traditional corporate structures or management hierarchies. This transformation extends to our public institutions as well. Governments and central banks are no longer just observers, they are active participants. Many are exploring the creation of central bank digital currencies, or CBDCs. These would be digital versions of a country's fiat currency, issued and backed by the central bank. While different from decentralized cryptocurrencies like Bitcoin, CBDCs represent a major step in the digitization of money. The journey of digital money is far from over. We are still in the early innings of a profound technological and social transformation. One of the most pressing hurdles is scalability. As more people use networks like Bitcoin and Ethereum, transaction fees can rise and confirmation times can slow down. Developers are actively working on solutions such as Layer 2 protocols. Regulation is another major frontier. The key challenge is to strike the right balance between protecting consumers and preventing illicit activities without stifling innovation. The user experience also needs to evolve. For many people, interacting with cryptocurrencies is still too complex. Looking further into the future, we can imagine a world where the financial system is truly global, open, and interoperable. A world where value flows as seamlessly as information does on the internet today. Programmable money could enable entirely new business models such as micropayments for content or machines that pay each other for services. Digital identity, secured on a blockchain, could give individuals control over their own data. The future of digital money is about building a more equitable, transparent, and empowered digital world for all. The story of digital money is the story of a powerful idea that took decades to come to fruition. It began with the cypherpunk dream and navigated through failed experiments until Bitcoin clicked all the pieces into place. From a single white paper has grown a global ecosystem that continues to reshape our world. We are at the beginning of a paradigm shift to a more distributed and collaborative world.